Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. It is comforting to see, even after the falls in late September, or maybe because of those eventually restricted falls, that the market is still keeping within the broken May to October 2020 bullish shift pitchfork. Now, prices had since August moved down from the upper time, currently 24.43, through the middle time, currently 22.73, plus down through both the now flatlining medium moving average, currently 22.51, plus also through the 50% Fibonacci line of the June to October 2018 move at 22.21, to eventually rest within a combination of the March to August 50% Fibonacci line at 21.60. Then also the very slowly rising long moving average at 21.53 and the 50% Fibonacci line of February 2018 to March 2020 move at 21.28. And finally, it's the old lower descending triangle trend line, currently 21.26 of the May to June move. Now, there was an attempt lower 2 weeks ago, piercing the lower time, currently 21.02, but without a single close below it. Hence why I think the broken May to October 2020 bullish shift pitchfork is still ruling this market's gentle bullish rise overall. It was, as I said 2 weeks ago, and I quote, "Until that lower time is broken, the shallow, gently bullish shift pitchfork will run this market, but that may be sooner than many think if you're not too careful," end of quote. And only fly in this bullish ointment is actually the action we'd seen on Monday. On the surface, it looks like a shooting star pattern, type 1 bearish, that had been capped by the flatlining medium moving average. However, the shooting star patterns also have a type 2 bullish pattern, perhaps a little less common, as it is a 2-day pattern that relies on a strong first day, Friday in this case. However, an ideal pattern would have had a gap between Friday's bullish white Mariposa and the next day's action, and in this case there is none. So be cautious about today's move up until we see at least a couple of strong consecutive closes over the medium moving average, currently 22.51, which we've had an attempt today, and also the short medium moving average, currently 22.55, again another attempt today, which has come down to reinforce the medium moving average. LME 3-month tin. I have been repeating this here again and again for months now. The overall bullish incentive is still alive and strong here. This was and is because the original move up, which started back in March of this year and then translated to a higher level in April, was due to prices moving up over the middle time, currently at 35.615, of the January to March bullish shift pitchfork. Prices even finally reached up and over the upper time, currently 37.995, but have since come back within its folds of this bullish pitchfork. In all this time, this bullish pitchfork had and has driven prices higher. Admittedly, in all this while, no market can head in one direction all the time. Thus, in August, specifically on the 19th of August, the market made a major correction lower. Yet this did not break the bullish incentive, as prices were still within the bullish shift pitchfork, ably supported this time by the lower time, currently at 33.230, as well as its partner, the rising medium moving average, currently 33.180. The second test lower in early September was enough to trigger an even stronger move higher, pushing up through the middle time, currently at 35.615, and peaking a little under the upper time with a 2-day over the weekend pipe top. Over the next few days, prices looked like they may have peaked, especially with the big drop 2 weeks ago that pierced the lower time, coming to a halt around the August low at 31.250 before recovering and actually closing back within the original bullish shift pitchfork, just under the recent 50% Fibonacci line at 34.040. Since then, the market has regained all of the one big day loss, with some stuttering last week moving higher, such that this past Monday we saw the third highest high ever with a day 2 in a 2-day meeting lines pattern. Now, this one is interesting, as traditionally this type of bearish is a bearish 2-day pattern. However, data indicates that is in reality a bullish pattern just over half the time. Hence, it was interesting to see whether the prices would follow on in tradition or the data. In the end, the market became more complicated by last Monday and Tuesday becoming a true bullish 2-day meeting lines pattern. Interestingly, today has seen a somewhat lackluster follow-on, dipping low and recovering at this time as we sit just underneath the all-time highs. This brings me to my final point, which is a repeat of part of a previous commentary that I've repeated on virtually every occasion since. It is, and I quote, "It can be hellish to rely on only one pattern because it can be hellish when it breaks." End of quote. So, and that is where we are now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.